All right, what we're about to walk through is a stress test. Think of it as a thought exercise, a plausible scenario pulled from a fictional macro memo that's dated June 2028. Now, this isn't a prediction. The whole point here is to model a very specific kind of economic shock, one that isn't cyclical, your typical boom and bust, but is instead driven entirely by technology.
And this really gets to the core question of this whole analysis. We're all conditioned to think that technological progress is always a net positive for the economy. But what if the most optimistic, most bullish case for what AI can do actually ends up triggering some profoundly negative side effects? What if being right about the tech means being catastrophically wrong about the market?
So, let's set the scene. Picture it. It's late 2026. The market is absolutely euphoric. We've got this AI-fueled productivity boom, corporate profits are at all-time highs, everything's looking golden. This is the calm before the storm.
And the speed of the collapse in the scenario, it's just staggering. In a little under 2 years, we go from an S&P 500 peak near 8,000 all the way down to a devastating 38% drawdown. Unemployment skyrockets past 10%. So what on earth could cause a reversal that fast and that violent?
Well, the answer, at least in this model, lies in this concept called ghost GDP. Just imagine for a second a GPU cluster out in North Dakota that's generating the same economic output as, say, 10,000 workers in Manhattan. Now that output, it shows up in the GDP numbers, but the money? It never actually circulates into the consumer economy through salaries. It's not buying groceries, it's not paying rent, it's not funding a night out.
So on the left, you've got your classic Econ 101, a closed loop where firms pay wages to households and households turn around and buy goods from those same firms. Simple. But in the AI-driven model on the right, that critical wage link is just severed. Output is being generated, for sure, but the money never flows back to households. And when that happens, the velocity of money just flatlines. It craters.
Okay, so how does a theoretical problem like this actually turn into a full-blown crisis? Well, it starts with the first cracks appearing in the system, when AI's role shifts from being a helpful assistant to a direct replacement. And it all begins in the software sector. By late 2025, these agentic coding tools got so powerful that a single developer could basically replicate the core functions of a major software product in just a few weeks. And suddenly, every CIO in the country looking at a $500,000 SaaS renewal started asking a very, very dangerous question. Hey, what if we just build this ourselves? And that put immense, crushing pricing pressure on the big vendors.
And this was the first real shockwave. ServiceNow was supposed to be one of the safe ones, a sticky system of record company. But their Q3 2026 report showed two really scary things. First, their growth was slowing down. And second, and this is crucial, their own customers were using AI to cut their own headcount, which meant they were canceling ServiceNow seats. The very tool that was boosting their customers' margins was destroying their own revenue base.
And this is where we get to the central, kind of crazy paradox of this whole crisis. See, unlike previous tech disruptions where the old guard resisted change, here they couldn't afford to. The companies most vulnerable to AI didn't fight it. They embraced it, aggressively, just to cut costs and survive.
Look, for any one CEO, this is a no-brainer, right? You lay off employees and you reinvest those savings into more powerful AI tools to get an edge. But when everybody does this at the same time, the collective result is absolutely catastrophic. You create this feedback loop where every single dollar saved on labor goes to fund the very technology that makes the next round of layoffs not just possible, but inevitable.
And this is where the crisis breaks containment. It doesn't stay neatly packed away in the software world. That same ruthless logic of efficiency starts to dismantle any business model that's built on, well, human friction or intermediation.
Which brings us to this idea of habitual intermediation. Think about it. For decades, trillions in enterprise value have been built by monetizing simple human limitations. The fact that we get tired of shopping around, we stick with brands we know, we forget to cancel subscriptions we don't use. All those little inefficiencies are a massive, massive profit center.
But see, AI agents, they don't have these limitations. They're working 24/7 in the background, optimizing absolutely everything. They're canceling that gym membership you haven't used in 6 months. They're reshopping your car insurance every single year to find the absolute lowest rate. They check 30 different food delivery apps just to save you $2. The friction that companies relied on for profit, it just vanished.
And the moment where everybody realized this was serious,
The point of no return came with MasterCard's Q1 '27 earnings. That one little phrase in their report, agent-led price optimization, it sent an absolute chill through the market. This wasn't just about a single product anymore. AI agents were now attacking the fundamental plumbing of the financial system itself.
So here's what was happening. Instead of your agent using a traditional credit card with its 2 to 3% interchange fee, it was routing your payments through these alternative digital rails, like stablecoins, for a tiny fraction of a penny. That 2 to 3% fee, that's the bedrock. The entire card and rewards ecosystem is built on it. And the agents found this inefficiency and just systematically eliminated it.
Okay, so let's connect the dots here. We've gone from a software problem to a payments problem, and now we get to a full-blown systemic crisis. And it's all driven by a nasty negative feedback loop that this memo calls the intelligence displacement spiral.
This slide is absolutely critical. A traditional recession, the one on the left, is self-correcting. You overbuild, things slow down, rates fall, and eventually new construction picks back up. But the AI loop on the right, it has no natural break. Cheaper AI leads to more layoffs, which weakens the economy, which then forces companies to invest even more in AI to cut costs further. It's a one-way street, and it's heading down.
This is what the memo calls the Great Displacement. You have high-skill, high-wage workers in tech and finance losing their jobs. But they don't just sit on the sidelines. They flood the gig and service economies, creating this massive oversupply of labor and pushing down wages for literally everyone. A crisis that started at the top of the income ladder quickly metastasized all the way to the bottom.
So for all you bankers listening, this is the key takeaway. 2008 was a crisis of credit quality. Bad loans made to unqualified borrowers. This 2028 scenario is a crisis of income stability. The borrowers are prime, their FICO scores are great, the loans look good on day one. The problem is that the high-paying jobs that back those loans have structurally disappeared.
And this is how it all blows up the financial system. The $13 trillion U.S. mortgage market becomes the transmission mechanism. As these stable white-collar incomes start to get impaired, all of these prime mortgages begin to default, creating a direct, terrifying link between weakness in the labor market and systemic financial risk.
So this slide really brings the whole thing together. You have these three interconnected reflexive loops just feeding on each other. A real economy loop of job losses, a financial system loop of tightening credit, and then a policy response that's just too slow to stop the spiral. It's a perfect storm.
Which brings us all the way back to today. And I'll say it again, this isn't a prediction. It's not a crystal ball. It's a stress test. It's a tool for asking some really hard questions about the assumptions that are propping up our current portfolios.
And the potential impact we're modeling here, it's brutal. A peak-to-trough drawdown of 57%, taking the S&P 500 all the way from 8,000 down to 3,500. Now that's a collapse that's comparable in scale to the global financial crisis. It's a left-tail risk for sure, but it's one with a plausible mechanism behind it.
So we'll end with this question, and it's one for you to really think about. Look at your own portfolio. Look at the entire economy. For all of modern history, we have built every single financial model we have on one core, unshakable assumption: that human intelligence is a scarce and valuable asset. This stress test is really just asking one simple thing: what happens if that's not true anymore?